Hey everybody, grass is starting to turn green. We're getting some buds on the trees now. And you know what that means? Spring is here. And that means driving season, my favorite time of year. Hey, I'm Aaron from the Oil Balance with 30 years of experience in oil trading and analytics. So this week in oil, let's do a mini dive on gasoline. Start out this week looking again at the headlines. So let me move this here. There we go. And I'll pop myself back in there. Okay, so here we go. On the tariff front, we haven't had a whole lot of headlines, at least as far as it concerns the oil market. It sounds like there's some tit for tat going on between the US and the EU, and now there's even more sanctions put on the EU, especially in regards to alcohol and things like that. So, again, it doesn't directly hit the oil market. There's not a whole lot of new news about tariffs on the oil market week on week. But I think the idea that we are sort of expanding the umbrella that tariffs are covering now, and it just keeps getting bigger and bigger, is probably a bit concerning. Hopefully, negotiations can start happening and where we can come to some determination and start reducing these and getting, you know, back to a more manageable market where things aren't always in flux from a tariff perspective. One thing I will say, though, it looks like Canadian crude oil imports to the US were down about 10% week on week. So the previous week, we imported just over 4.1 million barrels per day into the US, at least into PAD 2. This week, that sort of dropped down to 3.6 million barrels per day. So I would assume that that's something tariff related, especially because we didn't have any big change in refinery operations week on week. So it seems like, it's a pretty decent drop. It's probably a bigger drop than what we would normally see on a week to week basis. And maybe I'm reading too much into it, but it's certainly the timing would certainly line up for a drop in imports based on the tariffs. On the Ukraine Russia front, as you've probably seen in the news, there's been talks of a 30-day ceasefire. It seems like Ukraine and Trump are on board with the 30-day ceasefire. Putin, not so much. He wants a more lasting peace, is what he's saying. So the fighting continues, at least for now. In terms of direct oil market contact, the Treasury Department did let an exemption expire that let us do business with Russian banks. So, in other words, you could do an energy deal with a Russian bank in U.S. dollars with these banks that were covered under this exemption, and that transaction was allowed to go through. That exemption has now lapsed. If you wanted to do an oil transaction in US dollars with a Russian agency, you wouldn't be able to do that at this point. So it's kind of funny. This time last week, we were talking about, hey, maybe Trump will repeal some of these sanctions on Russia. Maybe we can actually get some Russian euros coming to the Gulf Coast, which would actually be a pretty good thing. And now we've got exactly the opposite, where it would actually be pretty much impossible to do that the way things stand today. Europe is still talking about sending troops to the Ukraine. Russians are still fighting, and it looks like they're still taking a lot of ground, at least in the Kursk area. Again, I'm not a subject matter expert on that, but just from what I've been able to see. So, when I put all those things together, it seems to me like there's still too little risk premium in the market for everything going on in the Ukraine, and that could still sort of expand into a larger regional war. And I don't think anybody wants that, but that's it's still a potential, and it's still probably relatively small probability sort of thing, but it still is a potential. Getting a little bit more detail on the Iranian front, the Iranians are saying they are cooperating with the International Atomic Energy Agency, which is good because a lot of the strife between the West and Iran comes from them trying to develop their nuclear situation. So Khamenei is saying that they're not trying to develop a nuclear bomb. I mean, that's what the man has said. He's also saying that Iran is capable of hitting back at the West if needed. The implication was militarily that they could hit back at the West. So again, they're trying to get talks where they're seen as an equal with the U.S. So at least there's some back and forth about, the two parties should talk. I guess maybe that's the silver lining there. And then the International Energy Agency came out with their latest report on the 13th, and they actually increased demand by 100,000 barrels per day across all of 2025, but they reduced their call on OPEC by about 200,000 barrels per day. So again, what the IEA does is they try to say, if here's what demand's got to do, here's what we think the refining complex can do, and then to have a perfectly balanced market where supply equals demand, here's where OPEC would have to come in and supply the market. So, I believe that was at 26.7 million barrels per day, and they dropped that to 26.5, if memory serves correctly. So it makes it a little bit difficult from the perspective, if you believe the numbers from the International Agency coming out of France, it makes you wonder a little bit how OPEC's going to pull off bringing barrels back to the market to the tune of, I think it was 137,000 barrels per day per month between April and the end of the year. And again, pretty evenly spaced around that amount each month. And they're not trying to prorate it where there'd be more barrels in the summertime when the market sees the highest demand or anything like that. But let's jump into gasoline markets. So the good news for consumers is we are seeing sort of a counter-seasonal trend, if you will. Prices this time of year should be ramping up. Both a year ago, they increased back here in 2019. So just to give you a taste of sort of the final pre-COVID year of President Trump's first term, we did see gasoline prices go up. Again, that's a seasonal thing. There's an RVP change going on this time of year, which makes it harder for the refiners to make gasoline. You're limited by how much vapor pressure can be in the gasoline, which means some of the really cheap blend stocks like butane get pretty much worked out of the gasoline blend. And then you're adding things like additional reformate into the gasoline, which is somewhere like 22 cents above the screen here in the Gulf Coast, 22 cents above April futures. Whereas the A grade itself, the Gulf Coast CBOB gasoline, is trading, 16 cents under. So that's a huge spread to try to put in higher octane, lower RVP blend stock into your gasoline. So if we continue this downward momentum, again, that would be a good thing. We would need crude prices to sell off. That's probably your biggest driver outside of just the spec change itself. But so just to put things in perspective, I know there's been some ink spilt on the political side of things saying, hey, gasoline prices are lower year on year. It's true. You can see it here in this chart. It is counter seasonal. All I'm saying is that normally we would get a bump this time of year just because it's harder to make the summertime gasoline that we're going into now. On the diesel front, this chart over here, we are again slowly grinding lower, almost 50 cents below year ago levels now, so that's a decent drop. But again, we were much cheaper back in 2019, sort of good demand year, and before COVID hit or anything like that. So sort of the last year of Trump's presidency that was normal, meaning we didn't have COVID type issues going on. All right, but let's look at how we're set up going into driving season this year. Pad 1 gasoline is actually doing pretty well. For this week, we're a little bit above the 5-year range, which is pretty good. We're quite a bit above year-ago type levels. However, we do have some big turnarounds going on. I think as I showed you last week, Pad 1 runs are down around the 500,000 barrel per day mark, which is really quite low. Should be closer to 800,000 barrels per day. On the Gulf Coast, we've seen a huge drop. And again, we saw something similar last year, but this year we've definitely seen a huge drop in inventories. And we've been running our refinery kit harder. So you would think that it wouldn't be as big a drop as this. But we're down here near the bottom of the 5-year range in Gulf Coast gasoline stocks. And remember, this is important because we do ship a lot of gasoline from the Gulf Coast through pipelines up into Pad 1. So Pad 3 is Gulf Coast, Pad 1 is the East Coast. So that's sort of that tie-in there. There is a little bit of barge traffic that goes back and forth between the Gulf Coast and, say, Tampa area in Florida, which is technically Pad 1 as well. But the majority of the volume ends up going on pipeline. So, which brings us to the gasoline yield. So if you look at what's produced divided by just the crude input, yields are actually pretty low for gasoline, lower than year ago type levels. Still within the 5-year range, so that's good. And looks like it would trend lower during this time of year anyway. At least it did last year. And then we've had some really strong demand numbers. We hit 9.1 million barrels per day on domestic gasoline demand this week, which is that's a really solid number. Again, it's 1 week, so don't want to make too much out of it. But what it's done to the gasoline days of supply is 2 weeks in a row now we've had this huge drop off. And so this is the lowest we've been. We're sitting right at 24 days of supply right now. And that's the lowest we've been since August of last year. So that's a fairly significant number and not a great way to go into driving season as far as market feeling a little bit tight from this perspective, just looking at days of supply. Maybe that demand number was too big this week, and next week it'll correct lower and pop the days of supply back up. But again, we've done some damage here these past 2 weeks on this days of supply chart. So looking at the April gas crack here, I've been using TradingView lately, so that's where this chart is coming from. On a daily chart, we have seen the market bounce back each day so far this week. On Friday, kind of a little bit lower. But earlier in the week, we did see a really good bounce back in the market. This is for the April contract. And it's running at a fairly normalish rate. So you've got $23 or so value for that April gas crack. In terms of sort of looking back, instead of just zooming in on the gasoline market, let's kind of look back for a second at the overall market. So U.S. product demand, with the help of that big gasoline number this week, the jet demand number was also pretty big at 1.775 million barrels per day. We're looking at pretty good domestic demand overall. Total crude supply went down. Again, we had a big drop in imports. Most of that drop was Canadian barrels that didn't show up, but we're still sort of keeping up with year-ago type levels. Total commercial stocks continue to draw. It probably should do that this time of year. Again, when we start to go into the late April, early May timeframe, inventories should be starting to slowly creep back up on total commercial stocks. So not too concerned about this yet. This is actually dropping slower than the 5-year average. So far so good, I think, on that. We just started at a low level, so that's fair. We are obviously at lower inventories than a year ago. Crude production, though, is really quite high. We put in 13.57 this week, so that's a very strong number. If you factor in all of the other things like the oil transfers and then the balance number, then you're actually looking at pretty run-of-the-mill type levels. But if you're just doing like on this chart and just focusing on that crude oil production number, it's actually looking pretty decent so far. So demand this week has been excellent. Last couple of weeks, we've been doing better than year-ago type levels, and supply has been about equal to year-ago type levels. So again, things seemingly shaping up somewhat bullishly if you're just looking at these sets of charts. But pricing-wise, the market still feels heavy. So crude continues to come off. We're now sort of below the low part from this time in 2023. Same thing with Brent. Gulf Coast gasoline continues to grind lower, and so we're sort of at levels we saw back in the fall of last year, which again is unusual because we are starting to go into that summer driving season. We are starting to price A2s now in the Gulf Coast, which is that summer spec. So a little surprising that we're pricing out like late summer barrels where you're actually going into a higher RVP situation where it's a little bit easier to make. On the diesel front, again, we're below where we started at the beginning of the year and kind of catching up to where we were back in late September, early October last year. And there's our pad map for the year. So keep in mind this was spring break this week, at least here in Texas. You could really see it in the overall volumes on crude futures. I believe on Tuesday this week, the total crude volume traded was almost 50% of what it was the previous Tuesday. And looking again, not just at the front month, but at the entire forward curve for the WTI contract. So yeah, we are getting a little bit less volume go through just because I think it is spring break this week and maybe people are off on vacation or whatnot. But let me show you one other chart real quick. If I can get back here. Here's a WTI continuation chart. Again, I'm getting this through TradingView. And I'm set this to a weekly view instead of daily. As we talked about last week on the weekly we looked at, we had a huge sell-off in the April contract last week. This week, if you can see, it's actually a pretty small move here overall. The open is almost equal to the close here, at least as of Friday as we're filming this. But this support line that we're hoping holds, again, it needs to hold against the body of the candlestick, not just the bottom of the legs of the wicks. That goes all the way back to November of 2021, late November, early December of 2021. So this has been a long time support level in the market. If we were to breach that, you're looking at maybe the 62 to 60 area as the next area of support. And then below that, you're probably looking back into the sort of the $50 area going way back into 2019. So skipping the whole COVID 20 and 21 years altogether. So that would be a pretty important sell-off from the standpoint that you're not going to get a whole lot of incremental production coming at least from the U.S. shale guys if we were to drop down in this $50 to $55 area for any length of time. It's one thing if we kind of just go down there real quick and bounce right back up for whatever reason. But if we stay down there, that would really discourage further investment in U.S. production. So again, just sort of keep that in mind. This chart shape is not looking too great for the bulls. We'll see if this change this week means anything. Again, it was kind of a light week with spring break and very light volume going on. So that's our video for this week. Hope you enjoyed it. Remember, if you have any questions or comments, please hit us up on our website, theoilbalance.com. Whether you're just interested in the market, or maybe you're a hedger and trying to lock something in, or maybe you're an active trader, we have the tools to help you look at the market like an institutional trader would. So come hit us up. We can help you. Thank you.